the founding partner and head strategist for Optimized Trading. Before we get started, let's break off with a disclaimer. Historical performance may not be indicative of future results. Future price characteristics are not always predictable or repetitive, thus any strategy developed using historical data will be equally unpredictable. Please consult your investment professional before choosing trading or investment strategy to ensure it meets your investment objectives and risk tolerance. All right, so about our firm. So Optimized Trading was founded in 2014. My business partner, Robert, acts more of the COO, while I am the head strategist. We set out to really, offer adaptive solutions for a plethora of different market types from a systematic and analytics perspective. Our investment approach, within our research, risk really comes back to outcome being dependent on a perspective of singularity. So whether that's exploiting a single source of alpha, a single variation of value, or a single setup, so to speak. So what we do within, we really set out to incorporate diversification, but much more specific and detailed within a systematic structure. So we implement dynamic multi-model alpha systematic structures, internal correlation efficiency analysis, and multi-entry capacity. The dynamic multi-model and multi-alpha is really taking a discretionary philosophy, if you will, of applying different setups or learning different trading setups, but applying those within a systematic structure. And so, really what we do is we break things down into it depends on which market, which frequency, but anywhere from 32 to 48 different proprietary market classifications. And then we'll design a strategic concept for those. And then the strategic concepts all reverts back to the market and the characteristics that are, that each market exudes, whether that's, more momentum or reverting characteristics. And it further breaks down into the type of value that we're wanting to exploit, such as random value or cyclical value. And so the internal correlation and efficiency analysis is kind of the overall control module, if you will. So we really implement, multiple sources of alpha, and they're diversified strategically. It's not just the same variations of the same concept. So, whether that's more for exploiting momentum, more for reverting, more for random, or for cyclical. But the internal correlation and efficiency analysis is more, we wrap all the individual sources of alpha within that structure, which allows us to track individual model performance as if they was all trading live. It also allows us to track performance efficiencies of our entry logic and exit logic within the order statement logic. And we use those as feedback loops, if you will, to create a constant pressure, if you will, of learning and improvement, continued improvement. And number 3 is multiple entry capacity. Multiple entry capacity gives us the ability to exploit random and cyclic variations of value within a single construct or within a single product application. But it also gives us the ability to compound alpha probabilities. For instance, if you are designing a model for market classification 10B, and then, but you see within your research 10B and 11F, so to speak, have a period in which they overlap, right? And so these overlapping conditions or sources of alpha can actually execute even when 10B is already executed and currently holding a position. Maybe one might be random, another might be momentum, or one might be random, the other might be cyclical. And so this further improves total outcome consistency, and that our entire approach is really designed for two primary objectives. One, time return consistency and risk mitigation. So, and not just from a drawdown perspective or a loss per trade perspective, but from a strategic risk perspective. We don't apply machine learning here like some other firms, because as we know, machine learning can be, whenever it's used to actually source alpha, it can be difficult to actually identify the underlying strategic risk, because we don't know sometimes why machine learning will choose certain alpha variants. Where we choose to exploit complexity is more on the systematic structure side, and that gives us the ability to draw upon correlations of our different sources of alpha, which are designed for different market environments. For instance, market condition 10B, if a model that's currently activated has performed well for a certain amount of time, then we have, historically speaking, a high probability that 11C or 11D may have a higher probability of showing a strong correlation or synchronization to the next market environment. So it gives us a predictive mechanism to switch to a different model. So it's used as a weighting mechanism to, instead of typical quote unquote meta strategy concept, sometimes they'll just use a equity curve switching mechanism. So that's reactive in nature. So you're waiting until the current model starts to perform poorly before you switch to a different model. In this instance, even though that we do have reactive measures in there, if a model's historical performance, and we track every model's performance as if they was all trading live, if it doesn't meet our performance requirements, then it's not even considered for activation. And by that point, to be honest, we probably already went back in and either looked at that model to see why it's not performing aligned. But that gives us the ability to really tweak a system without changing the overall systematic structure. So the multiple entry capacity, we found, again, in our research, that time and time again, whenever other quant firms fell or other concepts fell, a very large percentage of time, it all reverts back to outcome being dependent on a single strategic concept, a single source of alpha, etc. So our systematic structures, again, we do market classifications. Again, 32 to 48. Below that, we have the variation of value, random, cyclic, and this is really based on frequency strength of that market. For instance, the U.S. indexes really has a frequency strength between 42 to 48 minutes. So we typically just use 45-minute intervals here for markets that we trade, or daily bars. So we actually use minute because they're a little bit more accurate. But strategic concept is, again, based on per market classification, and then it subdivides down into the variation of value, and then the dynamic entry order statement logic. And we will include within each complete product, anywhere from 16 to 34 individual sources of alpha. Some of those are completely different strategic concepts designed for completely different market environments and substructures, and some are even overlapping. So you may have, two that kind of signal close together, but they're searching for completely different things, and all of which are repetitive in nature, historically have been, and offer a good payoff matrix. So, and then each entry model that we include, or each source of alpha, comes with its own set of exit logic. It's very tuned to that model, to the current market environment, to the current characteristics, to optimize how much return we can seek, and or to protect return, to mitigate return. So we include three types of exit models. One is obviously a profit models, dynamic profit models, and we include about 8 different different strategic profit models that are looking for different things. And then we have NPLs, which are non-profit and loss, which are exit models that are applied that are that don't consider profit or loss at all. They're just looking for events that's happened within the market that that's not favorable to the current position. And then obviously we have our stop logic and dynamic stops. The IMM control module, this is where we wrap and where we pull everything together. It allows us to really take our concepts to another level by allowing us to internally analyze performance efficiencies of entry and exit logic, individual model performance, and then alpha correlation and synchronization. And alpha correlation is actually really critical, because whenever you developed a strong source of alpha, these different sources of alpha historically can go in sequence to one another, and you learn that historically. For instance, model 2B could be correlated to model 5C, etc. So that gives you not just a way to weight the next models, but also whenever you're tracking performance, it also gives you another way to really exploit the probabilities of those models by being able to dynamically adjust how many shares and how many contracts you're allocated to each source of alpha. And typically how we do things here on products where we're not as restricted on the number of contracts that we deploy, we will allocate typically a larger percentage to cyclical variations of value than we do to random. And the reason for that is random variation of value, price can always fall the furthest from where it currently resides. So historically speaking, momentum concepts and random concepts have the highest risks. So those will apply a smaller percentage. Maybe if we have a 10 contract max, maybe those will deploy 2 or 3, whereas cyclical may be 4 or 5 or 6 or 7, etc. And then we have obviously efficiency loops, and this is another part of the IMM control module, which is, again, it gives us the ability to apply, a continued pressure within the order statement logic, for adaptive strength, and to increase return, reduce position risk. And basically how we do that is we look at each position, each entry executed, and after that position closes, we go back and track, okay, what was the low of each bar that occurred during our position? What was the high of each bar that occurred during our position? And obviously the open and the different swings that occurred between. But that gives us the ability to say, okay, how could that entry logic been improved? Was it relatively close to being near the low? And then we take a percentage of that difference, and then loop it back in to apply a constant pressure again and that's both on the entry logic and on the exit model that was executed at the time. And again, this is the IMM. It's really the nucleus of what we deploy. It really, even though that all of the individual sources of alpha could be traded as an individual concept, it's really what pulls everything together and allows us to not just exploit different market environments and substructures, be able to diversify the factors that produce outcome, but also really push efficiency as far as we possibly can. And really the multi-model structure is very different from I guess the traditionalist way of how systems are deployed, in a sense that we don't take a single concept and over optimize it or to work, quote unquote, in every market environment. We don't try to fit it to work on 20 years of data. Instead, we are only looking at very specific, conditions and substructures and saying, okay, is that condition and substructure repetitive? Is it identifiable? And then, that's really how that pushes efficiency to the maximum level. And these models and strategic concepts are independently evaluated, correlated, and validated before they are included within the IMM. So again, we don't use machine learning to identify the sources. We do that here on our own. We typically include anywhere from 6 to 8 different strategic concepts within each product. And then obviously we'll have some variations of each concept. But that's typically how the entire systematic structure is. So, multiple entries. So this is a really, when it comes to systematic trading and quantitative trading, most quant firms step into positions. However, they may do it because of size, or fill efficiency. But again, our research really came back time and time again that everything, risk is really dependent on things or perspectives of a singular nature. And so, multiple entries, again, it really gives us the ability to compound alpha probabilities, reduce risk, and increase risk or increase return over time. And it's really designed, really for outcome consistency and pursuing consistency over return. Our current systems can add, 1 to 2 additional or 1 to 6 additional positions. And again, whenever you're allowing multiple entries, one of the main risk factors of a single entry, single exit concept or strategy is randomness, right? Because randomness is somewhat stochastic in nature. And so whenever you're allowing multiple entries per positions, it actually gives you the ability to flip randomness from a risk factor into something that you can exploit. And so it's really the ability to turn a negative into a positive, so to speak. We recently launched micro products for the ES, or MES, I should say. We have Atlas MES C3, C6, C10, and C10HR. And all of these products typically deploy, a very similar, systematic structure, sources of alpha. It's really just, how many contracts they're allowing, how many entries they're allowing, and then the performance objectives of such. So, 3 and 6 and 10 are kind of similar in that way. 10 HR is our quote unquote higher risk variant. It's tuned more for return than consistency. We thought that we would add a slightly different variant option for clients that are wanting a slightly higher return risk profile. But these products are currently available for our distribution partners. And so here's some execution examples of of the MES C10 HR, and this is pretty recent. I think I took the screenshot yesterday or the day before yesterday, but you can see, really everything is reverting in nature. So even though that, our we measure directional probabilities, multiple frequencies of momentum, where we are within a current market cycle, behavioral fundamental justifications. When it comes down to the order statement logic, a lot of, most of our models are reverting in nature. We want to seek some type of value, even on a momentum setup. Even when you push forward or push down, and you break through some type of level, or you identify some type of momentum source of alpha. We want to get in on that source, on some small or insignificant, pullback, so to speak, just to improve our fill to some degree at least. But, as you can see, we are executing multiple entries, and those are two completely different, models that executed. And then here's the C10HR in 2018. As you can see, these models are, deploy completely different exit logic, so they're not all exiting at once. It's not position linked. We do have position linked exit logic, so they can all exit at once sometimes, but a large percentage of times they will be independently evaluated, because some models are designed to exploit slightly different movements than others, or completely different, but they can still occur, within a different, within a similar structure, so to speak. So you can see we label every model that we include, and so you have MS7, S1, MS7, S5. And so, these models are really designed to seek different things historically, but again, they can have overlapping conditions or timeframes in which they're looking to exploit within the marketplace. And so, here's two long models that executed within the same bar, but again, seeking two completely different types of value. And maybe historically, over the past 20 years, that could have been the only time in which those two models overlapped with or executed within the same bar structure. So, we really try to mitigate the risk of really seeking the same of too much one thing within a design structure, and that's the reason why we really work hard to not only include a multi-model structure, but not just fill it with variations of the same concept, but we're looking for completely different things, using different proprietary analytics to derive what we're looking to exploit. And then here's the C10HR within 2008, 2009, and as you can see, we're going both long and short in 2008, 2009. Contrary to popular belief, you can go long and downtrends and be profitable. You just have to know, when to do it. It has to be very specific. It's much more specific, obviously, than when you were going long in upward conditions or uptrends. But you can definitely, exploit from a long perspective. And so, that's another reason why we primarily focus on markets which are offer a linear bias or linear drift that's fundamentally and behaviorally justified. So we design concepts and products for large cap blue chip stocks, sector index, smart beta ETFs, and then index bond crude gold futures. Those markets typically, about 70-30% of the time have an upward bias. And so we really want to design a system that's aligned with that. We want to design something that exudes the same characteristics. So most of our products are around the same characteristics of bias that's exuded within that asset. And some assets are different. For instance, NASDAQ has much more momentum characteristics than the ES, and that's fundamentally justified, because the NASDAQ is made up of stocks more from a singular type of sector, whereas the S&P is diversified, much more diversified, and so that increases reverting characteristics. So, for instance, our NASDAQ concepts, obviously deploys more momentum models, or things that are designed to identify momentum maybe more effectively or more efficiently. However, we're still seeking some type of value there, even if it's a random value on a momentum type of setup. Let me see. And on the C10, if I don't know if you can tell or not, but these are all deploying a different type of contracts, right? Our C10 obviously has 10 max contracts, but they can deploy anywhere from 1 all the way up to 6 contracts per entry, right? And so some models may deploy 1 contract, some may deploy 6, and so everything is based on how effective, how efficient, the strength of that source of alpha, a combination of both how it's performed historically and how it's performed recently. And so that combination of tracking historical performance and then comparing it with, real-time performance, if those are not aligned, then that model, doesn't meet our criteria to be activated, even if the conditions within the market are aligned with that concept, even if it's quote unquote creating signals. If the real-time performance of that within the past few months has not been positive, then we won't. The IMM structure will not identify that as a potential source of alpha to activate. So it gives us a way to track performance, to validate, so to speak, a concept before it's activated, and then we obviously monitor. We monitor all the products here, and how they're performing, and so we're in a constant state of improvement here. So even if a new market event transpires and maybe it impacted performance, maybe it didn't, but we still want to go back and implement that data set within, to see, how could, any improvements been made? Did it change performance? Do small adjustments need to happen? Do we need to completely retune a model, or, is it no longer effective, right? And sometimes that happens too, right? Sometimes a model may be activated for 6 months and it performed really well during that 6 months or 3 months, and maybe its correlation subsides and it may not be activated again, but that doesn't mean necessarily that we're not going to go back in and add something within its place or retune it, or do something to ensure that the overall trade frequency is not negatively impacted, so we can still have a close fit to multiple characteristics within the marketplace. And really, whenever you're analyzing performance, you want to see, if you're looking at like an 18 or 20 year equity graph of return, you really want to see continued steady improvement. And within the metrics of your strategy, that really tells you that the characteristics that you've designed are of the market is actually growing closer aligned with what your strategy is designed to exploit. And so you want to see a continued improvement of performance, not a continued steady decline of performance. That basically says you're going the wrong way, right? And so we found in our research that the markets in nature are increasingly becoming more reverting in nature and more volatile. That's due to several factors. Obviously, we really don't use market data within our research prior to 1997, 1998. We will use it just as a confirmation, just say, hey, how did it perform, from 1990 to 1998, or whenever we have the first amount of market data. But we really don't use it to design the concept because, frankly, we saw a massive shift in market characteristics in 1997, primarily due to internet access. And so when you have, increased market access, obviously that creates more reverting characteristics, more volatility. And then obviously you have, machine learning trading that's came along. And so typically we'll use data from 1997, 1998 forward, and then we break it down not really into time but into conditions, and that's how we really develop products here. So it allows us to gain a close fit, but without, or I would say while reducing the risk of overfitting. Obviously that risk is always going to be there. There's nothing you can do about that. Even, if you're running a backtest or optimization, basically that's what you're doing, is you're trying to fit something to a data set. But, we believe, in keeping aligned with John Conway's works on rules and complexities. So, creatively simple underlying strategic concepts. However, we exploit complexity more from the systematic structure. And so, here is the C3. The C3 is different from the C10. Obviously, we only have three contracts to deploy. And so this one's a little bit more limited. We just do the money management is set up here to execute one contract per entry, 111 at all times. So whenever you increase the amount of contracts that you have to deploy, you actually increase, the versatility of the money management, the effectiveness of it, and the ability to really know when to push, and be more aggressive with money management on certain models or certain market environments. And, that's always a good thing. So, and here's C3 from 2015, 2016. As you can see, executions are kind of reverting in nature. We're looking to exploit some type of value, either from a long perspective, and sometimes those can actually occur intra-bar together, so they can reverse out. And so we have two sites, Optimize Trading and Optimize Your Trading. Optimize Trading is more for systematic, fully systematic products, whereas Optimize Your Trading is more for discretionary traders. So we offer strategy templates, full systematic strategies, proprietary indicator packages, and really, we apply the same mentality for those products as we do for everything else. So, every indicator that we offer is really multi-purpose, right? Because we believe that a discretionary trader needs a lot of tools in their belt, and it needs to be able to serve a lot of different functions, whether that's the different setups that you're looking to exploit, or the different market characteristics, or being able to analyze a market from different perspectives. So every indicator, it's not a one-off indicator. It's not just an RSI. It could be it could be momentum analyzing a whole different list of functions, such as directional probabilities, cyclic movements or cyclic strength, OBOS. So every indicator actually is about 30 indicators or more in one. So it has a lot of different applications, every single one of them. However, they may be designed to serve a more specific purpose, but the purpose itself can be subdivided down into many different subcategories. So it creates a lot of different applications within our indicator packages. So we do, again, indicators, systematic strategies, full strategies that we sell, and then strategy templates. And then Optimize Your Trading are for traders that want to add something that's completely systematic. It's fully automated, and again, those are offered through our distribution partners. If you have any questions, we have an open door policy. We really try hard to answer any questions that anyone has, whether it's purchasing an indicator or a strategy template, or leasing one of our systematic concepts. So please give us a call or email at any time. We'll be more than happy to answer any questions that you may have, regarding our concepts, our systematic structures, or our differentiating factors here at our firm. You can reach out at Robert at optimizedtrading.com, or myself, Brian at optimizedtrading.com. I appreciate the time, and as always, happy trading, guys. If there's any questions, I'd be more than happy to answer them.
Brian, are you still on the mic?
Yep, I'm still here.
All
I
right.
can't see any questions.
Sophie, Sophie's asking, can you show some performance or data?
Yeah, I can. Absolutely. Let's see. You have to forgive me. This is Robert's computer. It's aggressively slow. Well, if Sophie could provide her email, I'd be more than happy to send her some performance information. You can email me, Sophie, at brian@optimizedtrading.com. I'll be more than happy to send you an entire list of products, performance information, along with some screenshots, obviously of executions, but the MHT files, which come from TradeStation. We primarily design everything within EL. We realize that EL is somewhat restricted in nature, but we've we started with that because our distribution partners use EL. So we've spent a lot of time designing workaround solutions for a lot of the more complex systematic structures. But anyway, so our products can be used on TradeStation multi-charts. We also make them available for NinjaTrader. And so, that's indicators, every product that we have. So, shoot me an email, Sophie, at brian@optimizedtrading.com, and I'll get that out to you today.
Also, Brian, there is a question from Paul, and he is asking, what are the commission costs and exchange fees like?
Well, the commissions are set by the IB. We don't have any relationship with, we don't have any determining factors on the IB. I would imagine that some of that can be negotiated, but it depends on whether it's an Atlas product, an Atlas ES, or MES, or ES. So micros, obviously, commissions are lower than an ES, but we include commissions and slippage within our trading. And if you would shoot me an email, you'll see that within the MHT file that commissions and slips included within our performance metrics. So we want to be, overly cautious. We don't want, large commissions or large slippage to be a determining factor on outcome. So we use, overly large, not to mention that, our orders are, most of the time, they're limit orders. That helps reduce some of the slippage, so to speak. And our entries are reverting in nature, or the order statement logic is. So we're typically buying as the market's going down, which a lot of times, or sometimes you can even have positive slippage, which is always a good thing. The commissions on MES, I think, are through one of our IB partners, I think in the 550 range. For the ES, it depends on which distribution partner that you choose, or which IB firm that you choose, but that can be anywhere from 8 to 15, somewhere in that range. If you want a list, Paul, shoot me an email and I'll provide you some different options that that we work with, that we distribute our products to.
Thank you so much, Brian. If you guys have any other questions, don't forget to email Brian at optimizedtrading.com or robert@optimizedtrading.com. They're more than happy to provide you with more indication on commissions, on performance, etc. So any other questions for Brian? All right. Our next speaker is